A lot of people who are looking to get into income investing are wondering, which stock should I put my money into? What should I look for before deciding which stocks I should invest in? That is a pretty common question asked because everyone has different needs and many YouTubers out there tend to focus on lower yielding stocks, which offer higher returns over a long period of time. Examples for this are stocks like Target, Johnson & Johnson, Pepsi, Pfizer, and many more. However, our team tends to invest in higher yielding dividend stocks. That is why today we are going to discuss the full process of picking the best stocks for income investors. Please be aware that the information in this video is not financial advice. We are only showing our own process and how we want to invest our own money. We are not trying to convince you that our investing strategy is the best there is. Our methods of investing might be riskier. What works for you might not work for somebody else, and vice versa. If you are looking to put all of your money into something like S&P 500 and watch them grow forever, that is your choice. However, here on our channel, we are focusing on how to gain an additional stream of income as soon as possible. Consider this video a guideline that you can use to build your own portfolio and pave the way to your financial freedom. With that being said, let's jump into the video. The first criteria that we have for a stock that we are looking to invest is that it should yield more than 3.5%. The only exception we ever made is with the Schwab US Dividend Equity ETF. SCHD typically yields around 3%, which ensures that some part of the portfolio is still dedicated to growth. No matter what, it is important that everyone dedicates a small portion of their portfolio to growth. This is because if you have zero growth stocks in your portfolio, eventually inflation will eat everything you have. Not to mention that the current inflation that the world is facing right now is much stronger than everything before. Our advice is that if you are younger, you dedicate around 30 to 40% of your portfolio to dividend growth stocks, while the rest is invested in stocks that focus on generating income. Nevertheless, if you are in your 40s or older, we think that you should stack up on income-generating assets. The second criteria that we have set up for picking our stock is the following. If a dividend stock offers less than 5% dividend yield, it should either have a long history of increasing dividends or it should pay out the dividends on a monthly basis. Our team prefers receiving dividends every month over receiving dividends every 3 or 4 months. That does not mean that you should overlook quarterly paying dividend stocks, but we can all agree that it is better to receive money every month rather than receiving them every couple of months. The effect of compound investing feels so much better when you see money flowing into your bank account every month. Money that you can continue reinvesting all over again and watch your net worth grow continuously. But investing only in monthly paying stocks is not that good. It means that you are devoting yourself to just a small portion of the market. You are going to miss out on stocks like XOM, VZ, VFC, and many more. The third criteria that we have set up is that we do not invest in stocks that pay annually or semi-annually. If you are trying to live off dividends, it is not a good idea to invest in something that pays you once or twice per year, unless you own a very big number of shares. Fortunately enough, the companies that pay annually are not that much. Now, we are going to arrange our investment preferences. We know that you might disagree or have something to share, so we would love to have you in our comment section down below. Starting out, we have equity REITs. This is our favorite and most favorite financial instrument out there. Equity REITs are real estate companies that own or manage income-producing properties, such as office buildings, shopping centers, and apartment buildings, and lease the space to tenants. After paying the expenses associated with operating their properties, equity REITs pay out annually the bulk of the income to their shareholders as dividends. Equity REITs also generate income from the sale of properties. The high dividend payout requirement for REITs means that a larger share of REIT investment returns comes from dividends when compared with other stocks. For this reason, many financial advisors consider equity REITs to be well suited for investors seeking income, as well as for long-term investors seeking both income plus capital appreciation. Equity REIT dividend yields have historically been higher than the average yield of the S&P 500 index. In fact, Over the long term, more than half of equity REIT total returns have come from dividends. A key concern for many investors today is how to ensure enough income for a retirement period that could last for decades. Even in a low inflation environment, the cumulative effects of inflation over long periods can erode the purchasing power of portfolio assets. The dilemma for retirees is that it can be tough to stay ahead of inflation with fixed income securities, while equities, the traditional inflation hedge, are usually trimmed back to reduce investment risk. Our second favorite instruments are BDCs. Business development companies are a special type of investment that combines attributes of publicly traded companies and closed-end investment vehicles, giving investors exposure to private equity or venture capital-like investments. BDCs are considered specialty finance companies and primarily make investments in the debt and/or equity of small to mid-sized companies predominantly in the US. An example of investing in debt would be senior secured debt, subordinated debt, or unsecured debt. An example of investing in equity would be preferred stock or common stock. Some companies may offer 2 or more BDCs, one BDC for investing in their debt and other BDC for investing in their equity. Our third best option is dividend ETFs. A dividend ETF is an exchange-traded fund that holds dividend-paying stocks. Investors may choose dividend ETFs for income purposes or as a more stable alternative to growth stock funds. Investors may also be attracted to them because they commonly have lower expenses and are typically more tax efficient than dividend mutual funds. Dividend ETFs can also be an easier and more convenient way of holding a basket of dividend stocks, rather than building your own portfolio of individual dividend-paying stocks. An example of dividend-paying ETF is the famous SCHD. SCHD is an index fund that tracks the performance of large-cap value stocks in the US. It has a broader range than S&P 500, and the lower valuations in this ETF mean higher dividend yield. We believe that SCHD is a strong buy for those looking for long-term passive income. We already have a video discussing this asset, so please go check it out. Of course, there are other financial instruments such as CEFs, ETNs, MLPs, and others, but these are topics for another video. The stock market is changing every day, and those who adapt to the changes will make the most money. That is why we have laid out a foundation for you to start your own research. You should not blindly trust our criterias, but instead go to Google and start researching. Figure out what your current financial situation is and what you are trying to achieve. But please be realistic with your expectations. Do not think that if you start putting $100 every month in SCHD or any other stock, you will become rich in no time. Investing is not a sprint, it is a marathon. In order to survive that marathon, you need clear goals and a system to achieve them. One major factor for that system is the money you are making each month. If you manage to save $1,000 every month, you should invest more into income-generating assets. On the other hand, if you are someone who can manage to save only $100 to $200 every month, your best bet is to save or invest in growth stocks and switch up to dividends after you accumulate enough capital. Anyways, do not take our word as factual information, but as pace notes that would help you navigate through the world of investment. As always, we kindly ask you to leave your feedbacks about the content of the video and everything about it. We are always trying to improve in order to satisfy our viewers. Comment down below on what would you like to see next. Thank you so much for watching. We'll see you in the next one.